I'm sure all of us have used the word asset in many financial conversations. But have you ever wondered what really an asset is and how do you actually define an asset? Well, an asset is something that has a future economic value. For example, the money you invest in a fixed deposit in a bank will be higher when it matures. That is an asset. Likewise, your investments in land, gold, and mutual funds. The basic purpose of an asset is to transmit wealth over time. Hi, this is Karthik Rangappa, and in the 6th video of Personal Finance series, let's talk about asset allocation and the role it plays in your personal finance journey. Broadly speaking, there are few assets that you can invest in throughout your life to preserve, generate, and transmit wealth. These are gold, real estate, stocks, and bonds. Each one of them has its own unique set of characteristics. Let me quickly run you through them. Let's start with gold. Since the dawn of civilization, people have always tried to find cost-effective way to store, transport, and exchange wealth. It took us humans a while before we could zero in on gold and silver as an effective way of doing this. Precious metals like gold and perhaps silver is rare, thus ensuring limited supply. It takes time to mine, purify, and mold. Gold is easily understood, measured, and assayed. Gold is sufficiently dense so that small quantities of gold represents large notional value, and this can be moved around easily. So it shouldn't come to you as a surprise that even today, gold is considered as a must-have asset in a person's portfolio. Investors instinctively reach out to gold when all the other assets are facing stress. Historically, it is generally accepted that gold is also a great hedge against inflation. Let's touch upon real estate. Broadly speaking, real estate investment covers for land speculation and rental yields from housing and commercial properties. Each have their own unique characteristics and scale requirements. Each piece of real estate is unique and therefore it's not fungible like gold, nor can real estate be transported. So every real estate investor experiences different returns, unless you're investing in REITs. I would suggest you check out our video on REIT where I've discussed REITs in depth. Lastly, let's talk about financial assets. Assets that can be traded on the exchange benefit from standardization and uniform application of law and regulations. Standardization ensures that investors get what they've paid for, and regulations ensure that one investor is not favored over another. The most liquid and popular of these assets is equity, but the largest is fixed income and bonds. Equity investments are risky as they're volatile. But that said, I will not hesitate to say that it's equities which help you create wealth in the long term. But does that mean you have to make all your investments in equities? Well, this is where asset allocation comes into play. If you knew which asset amongst gold, real estate, equity, and bonds would perform well, then you may as well put all your money in that one single asset and wait for the returns to roll. But unfortunately, it's impossible to predict which asset will perform for the set period. The act of splitting your savings in a basket of assets is called asset allocation. If you're starting now, you will do well in terms of asset allocation if you stick to big liquid assets. When it comes to equities, you are fine if you stick to large cap funds, perhaps maybe even mid cap funds. Apart from large and mid cap funds, you can also consider investing in gold, real estate, and bonds. If you're starting out and if you're unsure on the proportions to invest in each of these assets, then doing a simple equal weighted allocation is just fine. For example, if you have 10 lakhs to invest across 4 assets, then divide 10 lakhs by 4 and invest 2.5 lakhs across equities, gold, real estate, and bonds. For gold, I would suggest you explore investing via SGBs. Of course, we have a video on that. And for real estates, I would suggest REITs. If you're young and have a long earning career ahead of you, then you should perhaps consider taking on more risk, which means to say more exposure to equity may not be a bad idea. Investing up to 70% in equity under such a circumstance is not a bad idea. The rest can be split between gold, bond, and real estate. However, one exercise that you need to carry out every year diligently is to rebalance your portfolio. For instance, if your equity portion has increased to 80% from 70% and your investments in gold and bond has declined, then you may want to book some profits in equity bring it down back to 70%, and invest that profit into gold and other assets. If you're older and if you don't have many earning years, then maybe you should consider cutting down on equity. Consider investing larger portion of your funds in less volatile instruments such as bonds and debt funds. Which configuration to opt for really depends on your age and risk tolerance. But the key here is to ensure that there is asset allocation and rebalancing periodically. Do comment below and let me know on how you asset allocated for yourself. I hope you like the personal finance series, and let us know if you want us to discuss any other topics under personal finance.